Welcome to Trading Mechanic. Let's do it in a better way. This video explains how to work with one of these concepts, the ICT fair value gap. Okay, we are currently on the Bitcoin 5-minute time frame. Before we get into how to utilize the fair value gap indicator in your trading, let's first talk through what a fair value gap is. Fair value gaps are most commonly used amongst price action traders and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances simply suggest that buying and selling are not equal. Fair value gaps are created within a 3-candle sequence and are commonly visualized on the chart as a large candle whose neighboring candle's upper and lower wicks do not fully overlap the large candle. The reason why a trader might be interested in where these fair value gaps occur is simply that the imbalance created by them can become a magnet for price in the future. Like any other indicator on the TradingView platform, the fair value gap indicator can be added to your charts by selecting it from your indicators button. We will show you how to add it to the chart at the end of this video. For now, let's understand its key features. First off, let's start with these green rectangles. They act as support. When the market makes equal lows, green shapes will be printed. Retail traders usually place their stop losses for a buy trade slightly below the support level. Since big institutions are aware of this, they proceed to grab the liquidity that has been formed. As soon as that happens, the indicator will display a green cross. As soon as these stop losses are triggered, the market makers will take the price in the direction it is supposed to go. So they place a large amount of orders to move the price up. And this is when the fair value gap and the market structure shift occur. When such imbalance is created, the market usually visits, or in other words, retests this level again. On the other hand, when price action is making equal highs, the indicator will display red rectangles on the chart. This makes a lot of retail traders believe that the market has reached its peak, so they begin to place sell orders around this area. Stop losses for these orders are typically placed slightly above the level of resistance. Big players see that and instantly fill the liquidity void. As soon as liquidity grabs for sell orders happen, the indicator will print a red cross above the price. When the majority of orders have been filled, the market makers take the price to the downside, and this is where bearish fair value gaps occur. Based on the information we have learned so far, let me show you how you can outsmart the vast majority of retail traders. The rules for a buy trade are as follows. First, wait for the market to form 2 equal lows. Second, the indicator must print a green cross below the price indicating liquidity fill. Third, a bullish ICT fair value gap must be formed with a shift in market structure. Fourth, price action must retest the fair value gap. Whenever that happens, a buy order should be placed when the candlestick retests the gap. The stop loss in this strategy will be positioned slightly below the fair value gap. Take profit target will be set at 2 times the risk with the adjustment of the stop loss to the break-even level as soon as the market reaches 1-to-1. Risk-reward exactly opposite should be done for sale entries. First, wait for the market to form 2 equal highs and a red cross above the price. Second, a bearish ICT fair value gap must be formed with a shift in market structure to the downside. Third, price action must retest the fair value gap. As soon as this happens, a sell order should be placed at the close of the candlestick that retested the gap. For short trades, the stop loss will be positioned slightly above the fair value gap. The take profit target will stay at 2 times the risk with the adjustment of the stop loss to the break-even level as soon as the market reaches a risk to reward of 1-to-1. Here's another example of a short entry. Here, the market also triggered our take profit target. Traders, remember, money management is key. Do not risk more than 5% for each trade with this strategy. When it comes to leverage, use no more than 20-to-1. I hope you enjoyed this trading strategy. Now let me show you how to install this amazing indicator. First step will be to log into the TradingView and open the charts. Then head over to the Indicators search tab and type in ICT-SM Trades. Select this indicator by Mickey. Make sure you keep the settings of this indicator on default. It works on all time frames and markets that have a high level of volume such as Forex, cryptocurrencies. Thank you for watching. See you in our next video.